On February 13, 1990, the most powerful man on Wall Street surrendered to federal agents with a single phone call. Michael Milken didn't resist. He knew what was coming. The man who'd invented junk bonds, high-yield, high-risk debt that had fueled a generation of hostile takeovers, corporate raids, and fortunes, had been under investigation for 18 months. The SEC had built a case so thorough, so methodical, that his legal team saw only one path forward: confession, cooperation, and whatever sentence the court would impose. But rewind to 1970. Milken was a young, hungry trader at Drexel Burnham Lambert, a mid-tier investment bank fighting for relevance against Goldman Sachs, Morgan Stanley, and the old money titans of Manhattan. He saw an inefficiency in the market, a gap between what corporations actually paid to borrow and what the market thought they should pay. That gap was an opportunity. Milken's insight was simple but radical. Companies rated below investment grade, the B-rated, C-rated firms that traditional banks wouldn't touch, could still raise capital if you paid investors enough interest to justify the risk. Those bonds became known as junk bonds. Drexel would buy them, bundle them, and sell them to pension funds, insurance companies, and wealthy investors hungry for yield. The fees were extraordinary. Drexel could charge 2 to 4% on issuance, then earn commissions on trades. In 1980, Drexel's junk bond desk generated $5 million in revenue. By 1986, it was generating over $300 million annually. Milken personally earned $550 million in a single year, more than any individual on Wall Street. The machine was printing money. The cost entire industries were being dismantled. Milken's junk bonds financed hostile takeovers. A corporate raider could borrow billions on Drexel's say-so, acquire a company, strip its assets, fire thousands of workers, and walk away with a fortune. The social cost, broken communities, pension losses, unemployment, didn't appear on Drexel's balance sheet. But Milken faced a choice, and he made it under pressure. The junk bond market was maturing. Competition was increasing. Drexel needed to expand its client base, secure more deals, guarantee more returns. Milken began using information from corporate clients to identify takeover targets. He made promises to raiders that couldn't always be kept. He moved closer to the line and then crossed it. In 1986, SEC investigators began examining Drexel's trading practices. They found evidence of insider trading, market manipulation, and parking, a scheme where Milken would temporarily transfer securities to allies to hide their true ownership, then buy them back later. The goal was always the same: create the illusion of market demand where none existed. By 1988, the pressure was immense. Drexel's leadership faced a choice: sacrifice Milken to save the firm or defend him and risk everything. They chose sacrifice. Senior partners began distancing themselves. Milken's allies quietly disappeared. He was isolated, expensive, and increasingly toxic to the brand. The SEC indictment came in March 1989. 98 counts: securities fraud, racketeering, insider trading, money laundering. The government alleged that Milken had earned at least $430 million through illegal activity. The charges didn't just threaten his freedom, they threatened to unravel the entire junk bond market. Milken's defense strategy was expensive, over $200 million spent on lawyers and expert witnesses. But the government's case was airtight. Cooperating witnesses, phone records, internal memos, the evidence was overwhelming. By April 1990, Milken pleaded guilty to 6 felonies, including securities fraud and mail fraud. The sentence: 10 years in federal prison, a $600 million fine, a lifetime ban from the securities industry. Milken would serve 22 months before his sentence was commuted, but the damage was done. The man who dominated Wall Street in the 1980s was now a cautionary tale. But the real cost wasn't paid by Milken alone. Drexel Burnham Lambert collapsed in February 1990, just days after his surrender. The firm that had generated billions in revenue over 2 decades filed for bankruptcy. Thousands of employees lost their jobs, investors lost billions. The junk bond market didn't disappear, it evolved. But the recklessness that defined the 1980s became harder to justify. Credit standards tightened, regulators imposed new rules. The easy money era was over. Milken's rise and fall had redefined what Wall Street could get away with. What's striking is how rational Milken's decisions seemed at each step. Take a profitable niche and expand it. When competition increases, push harder. When regulators close in, use your resources to survive. Each choice made sense in isolation. But compounded across years, they led to catastrophe, not just for him, but for thousands of people who had nothing to do with the trades. The Drexel collapse stands as one of Wall Street's most instructive failures. Not because Milken was uniquely evil, he was ambitious, brilliant, and willing to bend rules that stood between him and greater wealth. He's the same calculation 1,000 traders have made before and since. The difference was scale. When the calculation compounds across billions of dollars and thousands of transactions, the consequences become systemic. Milken spent a decade rebuilding his reputation. He paid his fine, he created a foundation, he invested in education and medical research. By many accounts, he's genuinely attempted redemption, but that doesn't erase the cost: the workers laid off in hostile takeovers, the communities damaged by asset-stripped companies, the billions evaporated from pension funds. The Drexel Burnham Lambert story is ultimately about a man who saw an opportunity, seized it brilliantly, and then faced the choice every ambitious person faces. When does scaling success become crossing lines? Milken chose to cross. The cost was counted in prison time, fines, and the collapse of an institution. But it was also counted in the thousands of ordinary people who paid the price for decisions made in trading floors they'd never see. Subscribe for more corporate collapses where brilliant strategy becomes catastrophic hubris. New investigations every week.